The financial media wants you focused on the daily price action. They want you watching candlestick patterns and support levels, while the real story unfolds quietly in industrial laboratories halfway around the world. Because while traders were celebrating or panicking over Friday's move to the low 60s, something far more significant was happening in South Korea that most people completely missed. Samsung SDI just validated the specifications for a production-scale solid-state battery line, and buried in the technical documentation is a detail that changes everything we thought we knew about silver demand. Not incrementally, structurally. This isn't about investment sentiment or trading psychology. This is about the periodic table colliding with industrial reality. And when that collision happens, prices don't adjust gradually. They adjust violently. What I'm about to show you represents the single largest demand shock silver has faced in modern history. Larger than the solar boom, larger than the electronics revolution. Because this technology doesn't just increase silver consumption, it fundamentally redefines what silver is used for and how much of it disappears into products that won't release it back into circulation for decades. The implications are staggering, and the market hasn't priced in even a fraction of what's coming. This is the story of how a battery breakthrough in Seoul is about to create a supply crisis that makes current deficit projections look quaint. And why anyone paying attention to spot prices while ignoring this development is looking at the wrong data entirely. Let's start with the problem this technology solves, because understanding the problem is the only way to grasp why the solution requires so much silver. For 3 decades, the world has relied on lithium-ion batteries. They power everything from smartphones to electric vehicles. They work reasonably well for most applications, but they have a fundamental weakness that no amount of engineering has been able to eliminate. That weakness is called dendritic growth. When you charge and discharge a lithium battery, especially at high rates, lithium ions don't deposit evenly on the anode surface. Instead, they form microscopic crystalline structures that grow like needles piercing through the battery's internal architecture. These dendrites eventually breach the separator membrane between the anode and cathode. When that happens, you get a short circuit. And in a high-energy density battery, a short circuit means thermal runaway. Fire! Explosion! This is why your phone charges slowly. This is why electric vehicles take 40 minutes at a fast charger. This is why battery packs are overbuilt with safety margins that add weight and cost. The entire design philosophy of current lithium technology is built around managing this dendrite problem through conservative charging protocols and redundant safety systems. The holy grail of battery technology has always been the solid-state design. Replace the liquid electrolyte with a solid ceramic or polymer. Eliminate the fire risk. Enable faster charging. Pack more energy into less space. Double the range. Cut the weight in half. Every major automaker has been chasing this for years. Toyota announced breakthroughs that never materialized. QuantumScape showed promising lab results but couldn't scale production. Volkswagen invested billions in partnerships that haven't delivered commercial products. They all failed for the same reason. They couldn't solve the dendrite problem at the anode interface. Graphite anodes couldn't handle the solid electrolyte contact. Silicon anodes expanded and contracted too violently. Pure lithium metal anodes were chemically unstable. Then, Samsung's research division found something that works. They discovered that a specific metallic element, when integrated as a nanocomposite layer at the anode interface, completely changes the lithium deposition dynamics. It creates a conductive matrix that allows ions to move freely, while preventing the formation of dendritic structures. The lithium distributes evenly across the surface instead of clustering into dangerous spikes. That element is silver carbon, nanocomposite architecture that acts as both a conductive framework and a chemical regulator for lithium plating. This isn't speculative. This isn't theoretical. Samsung has published the research. The prototype cells exist. The production timeline has been announced. And here's what matters. This isn't a situation where they're using a tiny amount of silver for electrical contacts or circuit traces. That's conventional use. This is different. This is silver, functioning as an active component in the electrochemical storage mechanism itself. It's integrated into the battery's fundamental operation, which means you can't reduce it without compromising performance. You can't substitute it without reintroducing the dendrite problem. The chemistry demands it. Understanding this distinction is critical because it explains why this demand is fundamentally different from previous industrial uses. When silver is used in electrical contacts or circuit boards, engineers constantly work to minimize the amount. They look for ways to use thinner layers, smaller contact points, alternative materials for non-critical applications. The silver is important, but it's not irreplaceable in most instances. But when silver becomes part of the fundamental electrochemical process, when it's the specific element that solves an otherwise unsolvable problem, the entire calculation changes. You're not optimizing for cost anymore. You're optimizing for function. And if the function requires a specific amount of silver to work safely and effectively, that amount becomes fixed. This is what creates inelastic demand. The automotive industry can't decide to build batteries with less silver if less silver means the batteries catch fire. They can't substitute aluminum or copper because those elements don't have the right electrochemical properties. They're locked into using silver at whatever quantity the chemistry demands. Compare this to something like jewelry, where demand is highly elastic. If silver prices double, jewelry manufacturers simply make smaller pieces, switch to silver-plated alternatives, or pivot to other materials entirely. Consumers adjust their purchasing. The market clears at a new equilibrium with lower volumes. That elasticity doesn't exist when silver is structurally embedded in technology required by law. Governments have mandated the transition away from internal combustion engines. Automakers have committed their entire product roadmaps to electrification. Battery suppliers have invested billions in production capacity. None of these commitments can be unwound because raw material prices increased. This creates a scenario where demand remains firm regardless of price, at least within a very wide range. Samsung won't stop building solid-state batteries because silver hits $100 per ounce. They'll pay $100. Toyota won't abandon their electric vehicle platform because silver reaches $150. They'll pass the cost to consumers or absorb it in margins. The only question becomes how high prices have to rise to pull enough supply out of other applications to satisfy this new demand, and given that most other industrial uses are also relatively inelastic. You can't build solar panels without silver, you can't manufacture electronics without silver. The adjustment mechanism becomes extremely steep. Now let's talk about scale, because that's where this goes from interesting to catastrophic for supply chains. A conventional internal combustion vehicle uses approximately 15 to 20 grams of silver. It's distributed across dozens of components: window switches, seat motors, mirror controls, engine management systems. Small amounts in many places. An electric vehicle uses more, roughly 30 to 50 grams depending on the model. The increase comes from inverters, battery management, electronics, high-voltage cabling, charging systems. Still modest amounts, but the growth in EV adoption has already created measurable pressure on industrial silver supply. Now consider what happens when you integrate silver into the battery anode itself. You're no longer talking about grams distributed across accessory systems. You're talking about coating requirements for every single cell in a battery pack that weighs anywhere from 400 to over 1,000 pounds. The surface area involved is enormous. The amount of silver required scales with battery capacity. Early engineering estimates from research papers suggest loading rates between 5 and 10 grams of silver per kilogram of anode material. For a large FAMAT EV battery, that translates to anywhere from 50 grams on the very low end to potentially several hundred grams for high-performance applications. Let's be extremely conservative. Let's assume the final production version uses just 50 additional grams per vehicle beyond current EV requirements. That brings total silver content to roughly 100 grams per car. Global automotive production runs at 90 million vehicles annually. Electric vehicles currently represent about 15% of that and growing rapidly. If 20% of new EVs adopt solid-state battery technology within 3 years, a modest assumption given the competitive pressure to offer longer range and faster charging, you're looking at roughly 3 million vehicles times 300 grams equals 300 million grams. That's approximately 10 million ounces of new annual demand. That might not sound catastrophic until you remember that global mine production is essentially flat at around 830 million ounces. Industrial demand already consumes most of that. The market has been running structural deficits for years. 10 million ounces is the entire annual production of a major mining country. It's the equivalent of another solar photovoltaic industry appearing instantaneously. And we're using conservative numbers. What if adoption reaches 50% of EVs? What if the actual silver loading averages 200 grams per vehicle instead of 50? What if luxury and commercial vehicles with larger battery packs require even more? Run those numbers and you quickly reach scenarios where automotive demand alone grows by 100 to 200 million ounces annually. That's 15 to 25% of total global mine supply redirected to a single application. Where does that silver come from? It doesn't come from new mines. You can't build a mine in 2 years. It doesn't come from recycling. Battery silver will be locked into vehicles for 15 years before it re-enters the supply chain. And it doesn't come from existing stockpiles, because those stockpiles have been drawn down by years of deficit conditions. The only mechanism that can balance this equation is price. Dramatic price increases that destroy demand in other sectors and pull forward marginal supply from sources that aren't economic at current levels. But here's where it gets more complex, because this isn't like industrial applications where higher prices simply reduce consumption. The automotive industry faces mandates. Governments have legally required the phase-out of internal combustion engine. Automakers have committed billions to electrification. Battery factories are being built right now with this technology in mind. They can't just decide not to build electric vehicles if silver gets expensive. They're legally and financially obligated to proceed, which means the demand is relatively inelastic once the technology is adopted. They'll pay what they have to pay, they'll pass the cost to consumers, they'll lobby for subsidies, but they won't stop building the vehicles. This creates a fundamentally different demand profile than anything silver has experienced before. It's not optional industrial use that can be engineered around. It's structural use embedded in products required by law. Think about what that means for price discovery. When you have inelastic demand meeting constrained supply, prices don't adjust smoothly. They spike, they gap, they overshoot. Because the buyers aren't looking at charts, they're looking at production schedules and regulatory deadlines. Let's put this in historical context, because the pattern has played out before with other industrial metals, and understanding those precedents helps calibrate expectations for what might happen with silver. In the early 2000s, palladium was trading around $200 per ounce. It was used primarily in catalytic converters for gasoline engines, but the amounts were relatively modest and the applications were well established. Then automakers began shifting away from platinum toward palladium for emissions control, because palladium offered better performance for gasoline engines at lower cost. The market didn't immediately recognize the magnitude of this shift. Analysts saw the transition happening, but underestimated how quickly adoption would accelerate and how inelastic the demand would become. You can't build a car without a functioning catalytic converter. Emissions regulations made them mandatory, and once engineers optimized their systems for palladium, switching back to platinum required extensive re-engineering. Within a few years, palladium went from $200 to over $3,000 per ounce. The spike wasn't driven by investment speculation or monetary concerns. It was driven by industrial buyers scrambling to secure supply for products they were legally required to manufacture. The automotive industry had no choice but to pay whatever price cleared the market. We're seeing the setup for a similar dynamic with silver, except the scale is potentially much larger. Palladium demand was constrained to one specific automotive component. Silver demand is expanding across multiple vectors simultaneously. Solar continues growing, electronics continue growing, and now automotive is about to surge dramatically through solid-state batteries. The difference is that silver starts from a much larger supply base, which means the price response might be more gradual initially. But it also means the absolute volume of new demand required to move the market is enormous. When that demand materializes, the repricing could be more violent, precisely because the market is larger and more established participants have more entrenched assumptions about normal pricing. Another historical parallel worth examining is rare earth elements around 2010. China dominated production and suddenly restricted exports for geopolitical reasons. The industrial world panicked because these elements were embedded in countless technologies with no ready substitutes. Prices spiked dramatically. Companies scrambled to secure supply. Governments declared rare earth strategic materials and funded domestic production. The rare earth crisis eventually moderated as new supply came online and demand destruction occurred in some applications. But the lesson was clear. When you have industrial materials that are genuinely irreplaceable in specific applications, and supply becomes constrained for any reason, prices can move far beyond what traditional supply-demand models suggest. Silver in solid-state batteries presents similar dynamics. The chemistry requires it. No perfect substitute exists. Supply is constrained by geology and geopolitics. And the industrial buyers have regulatory guns to their heads, requiring them to use this technology. That's a recipe for dramatic price adjustment when the market recognizes the mismatch. And this is just automotive. The same solid-state battery technology will eventually flow into consumer electronics, grid storage, aviation, maritime applications. If the silver-carbon anode proves superior, it gets adopted everywhere lithium batteries are used. Each sector multiplies the demand impact. Think about grid-scale energy storage for a moment. As renewable energy penetration increases, the need for storage grows exponentially. Solar and wind are intermittent. You need massive battery installations to smooth out supply and demand. Current estimates suggest hundreds of gigawatt-hours of storage capacity will need to be deployed over the next decade. If even a fraction of that capacity uses solid-state technology with silver anodes, the demand implications dwarf the automotive sector. Grid storage batteries are enormous. A single utility-scale installation might contain thousands of times more battery capacity than a passenger vehicle. Scale that across hundreds of projects globally, and you're potentially talking about demand measured in billions of ounces, not millions. The market isn't modeling this yet. Analysts look at current battery chemistry and project forward linearly. They assume incremental improvements in existing technology. They don't adequately account for phase transitions where fundamentally different approaches get adopted because they solve problems that couldn't be solved otherwise. Now let's address the counter-argument you'll hear from skeptics. They'll say the same thing they always say when confronted with resource constraints. They'll just find an alternative. They'll engineer the silver out. Technology always finds a way. That argument works for design preferences. It doesn't work for chemistry. You can substitute aluminum for copper in some applications because both conduct electricity adequately. You might lose some efficiency, but gain cost savings. You can substitute plastic for metal in structural components if you engineer the design correctly. But you cannot substitute chemistry when the chemistry itself is the solution. Silver's specific electrochemical properties, its ionization behavior, its interaction with lithium, its stability in the solid-state environment, these are not design choices. These are physical properties defined by atomic structure. If you remove the silver or reduce it below threshold levels, you reintroduce the dendrite problem. If you reintroduce the dendrite problem, you lose the advantages that justified solid-state technology in the first place. You're back to slower charging, lower energy density, and fire risk. Samsung and Toyota aren't using silver because it's convenient or fashionable. They're using it because it works where nothing else does. Decades of research tried alternatives. They failed. This succeeded. The automotive industry is about to learn what the solar industry learned a decade ago. When silver is integrated into the fundamental function of your technology, you don't have substitution options. You have supply constraints. And those constraints become your problem. Here's where the timeline matters critically, because this isn't a 2030 story or a 2035 speculation. Samsung has announced pilot production lines operational in 2025 with mass production scaling in 2026 and 2027. Toyota has parallel programs on similar timelines. The investment has been made, the factories are being built, the supply agreements are being negotiated right now, which means procurement officers at these companies are currently doing the math we just did. They're looking at their production targets, they're calculating their silver requirements, they're realizing that if they don't secure long-term supply contracts immediately, they won't have the material to feed their billion-dollar production facilities. This creates an invisible demand that doesn't show up in spot market transactions but absolutely impacts price discovery. When Samsung locks in a 3-year supply contract with a major mining company at prices above current spot, that sets a floor. When Toyota does the same, the floor rises. These contracts don't get reported in real time, but they change the supply available to everyone else. The spot market sees reduced availability and prices have to adjust to clear at higher levels. It's the same dynamic we saw with palladium when automotive catalytic converter demand exploded. The price didn't move gradually, it moved in phases as the market repeatedly discovered that supply was tighter than models suggested. We're in the early phase of that process with silver right now. The contracts are being written, the supply is being allocated, the physical market is tightening, but most traders are still looking at historical demand models that don't include this structural shift. This information asymmetry is temporary. Eventually, the market figures it out. Usually that happens suddenly when a major manufacturer makes an announcement or a shortage becomes visible in derivative markets. By then, the easy money has already been made by those who understood the industrial reality before it showed up in price charts. The fascinating aspect of this situation is how it demonstrates the difference between financial market perception and industrial reality. Financial markets are forward-looking in theory, but in practice they tend to focus on data that's easily quantifiable and already happening. They model trends and extrapolate. They react to news and earnings reports. They trade on momentum and sentiment. Industrial procurement operates differently. Engineers make technology decisions years before products launch. Supply chain managers secure materials before production begins. The financial implications follow the industrial decisions with a significant lag. By the time something shows up in a company's earnings report or a commodity's demand statistics, the underlying trend has usually been developing for years. This lag creates opportunity for those who track industrial developments, rather than just financial metrics. When you understand that Samsung has solved the solid-state battery challenge using silver, and you understand their production timeline, you know something that won't show up in silver demand statistics for another 2 or 3 years. But it will show up, and when it does, the market will reprice silver to reflect this new reality. Let's talk about what this means for the actual supply side. Because understanding demand is only half the equation. You need to understand why supply can't respond. Mining is fundamentally different from most industries. You can't just increase production because prices rise. There's a decade-long lag between discovery and commercial production. You need to find a deposit, prove its economics, secure permits, build infrastructure, develop the mine, ramp production. That entire cycle takes 10 to 15 years under optimal conditions. Silver presents additional challenges because most silver production comes as a byproduct of other metals. About 70% of silver supply comes from mines primarily producing copper, lead, or zinc. The economics of those mines depend on their primary metal. Silver is secondary revenue. This means that even if silver prices triple, you don't necessarily get significantly more production because the mines are optimized for other metals. The companies that own them aren't going to radically change their operations for what they view as bonus revenue. Terracellar mines exist, but they're relatively rare and the ore grades have been declining for decades. What used to require moving a ton of rock to get 15 ounces now requires moving 3 tons to get the same amount. Energy costs are higher, labor costs are higher, environmental requirements are stricter, water access is more constrained. All of this means supply is relatively inelastic on the upside. Prices can rise dramatically without producing a proportional supply response, especially in the short to medium term. The depletion of high-grade deposits is particularly concerning because it represents a geological constraint that no amount of capital can overcome. You can't create ore deposits, you can only discover them, and after more than 5,000 years of silver mining, humanity has already found and exploited most of the easy high-grade deposits. What remains tends to be lower grade, deeper, more remote, or in more challenging geological formations. All of these factors increase the cost and complexity of extraction. Some deposits that would have been economic at historical ore grades simply can't be mined profitably at current grades, even with higher silver prices, because the amount of rock that needs to be moved and processed becomes prohibitive. And then there's the political dimension. The largest silver-producing countries include Mexico, Peru, China, and Russia. Each presents unique challenges. Mexico has increasingly restricted new mining permits amid environmental concerns and community opposition. Peru faces recurring labor strikes and political instability. Russia is sanctioned. China prioritizes domestic industrial use. So precisely when global demand is about to surge because of solid-state battery adoption, the geopolitical environment makes supply expansion more difficult rather than easier. This isn't a normal supply shortage. This is a perfect storm of rising demand meeting constrained supply in an unstable political environment. The concept of resource nationalism becomes particularly relevant as silver prices rise. When a commodity is cheap and abundant, governments are generally happy to allow private companies to extract and export it. The tax revenue and employment are welcome, and the strategic importance seems minimal. But when a commodity becomes expensive and scarce, and especially when it becomes recognized as critical for strategic industries, government attitudes change. Politicians start asking why domestic resources are being exported when domestic industries need them. They start proposing export restrictions, higher royalties, mandatory domestic processing requirements, or even nationalization. We've seen this pattern play out repeatedly with various commodities. Bolivia nationalized its lithium deposits when lithium became valuable for batteries. Indonesia restricted nickel exports to force domestic processing. China has restricted rare earth exports multiple times. The pattern is consistent. Scarcity plus strategic importance equals government intervention. The recycling counterargument also deserves examination because it's frequently raised as a solution to resource constraint. The thinking goes that as prices rise, recycling becomes more economic and floods the market with secondary supply. This works for gold. Gold recycling rates approach 90% because gold is concentrated in high-value items and remains valuable enough to justify collection and processing. Silver is different. Silver gets dispersed. It's used in microscopic quantities across billions of products. There's 1/10 of a gram in your phone, 1/2 a gram in your laptop, a thin film in a solar panel, a nano layer in electronic components. The economic value of recovering that silver is often less than the energy cost of extraction. So despite being consumed in large volumes, very little silver actually gets recycled. The rate is below 20%. The vast majority ends up in landfills or remains embedded in products sitting in storage. Now think about what happens with solid-state batteries. Yes, they contain more silver than conventional applications, but they also have a 15-year service life. The silver that goes into a battery in 2026 won't be available for recycling until 2041. It's removed from the available supply pool for an entire generation. This creates what economists call a stock versus flow problem. The annual flow of newly mined and recycled silver has to serve all current industrial demand plus investment demand. But solid-state batteries represent a massive increase in stock demand, silver that gets locked away in long-lived products. Even if recycling rates improve eventually, there's a 15-year gap where all the silver going into batteries simply disappears from the available supply. During those 15 years, the market has to find that silver somewhere. It either comes from reduced consumption in other sectors, from drawing down remaining stockpiles, or from much higher prices pulling forward marginal production. There's also a compounding effect worth understanding. As silver flows into solid-state batteries and gets sequestered for 15 years, the remaining available supply has to serve all other demand. This remaining supply is essentially the float, the silver that's actively trading and available for industrial and investment use. As the float shrinks, price volatility tends to increase. Smaller imbalances between supply and demand create larger price swings because there's less buffer to absorb shocks. A shortage of 10 million ounces might barely move prices when there's a large float. That same shortage could spike prices dramatically when the float has been reduced by hundreds of millions of ounces locked into batteries. This dynamic creates a feedback loop. Higher volatility attracts speculative attention. Speculative positioning further tightens the available float. Tighter float creates more volatility. Industrial users get nervous about supply security and start building larger inventories, further tightening the float. The cycle reinforces itself until something breaks. Either prices rise enough to destroy demand, or new supply comes online, or alternatives get developed. Now, let's connect this back to market dynamics and what it means for positioning. Because understanding the fundamentals only matters if you can translate that understanding into actionable strategy. The disconnect between physical reality and paper price creates opportunity. When industrial buyers are scrambling to secure supply while financial markets remain focused on technical analysis and sentiment indicators, you get mispricing. When procurement departments are negotiating above-market contracts while traders are selling on chart patterns, the informed participant has an edge. That edge exists right now. The information about Samsung's solid-state battery technology is public, but not widely understood. The implications for silver demand are calculable, but not yet reflected in consensus forecasts. The supply constraints are real, but not yet panic-inducing to market participants. This window doesn't last. Information diffuses, markets adjust. What's not priced in today becomes obvious tomorrow and overpriced the day after. The opportunity exists in the gap between industrial reality and market perception. For physical holders, this changes the calculation around what to own and why. In a world where industrial demand is about to surge dramatically, you want exposure to the most efficient form of the metal. You want maximum weight at minimum premium. You want liquidity to institutional buyers who might be scrambling to secure supply. Large bars become more valuable than collectible coins. Government bullion becomes more valuable than numismatic premiums. Weight becomes more valuable than presentation, because when Samsung or Toyota needs silver for production, they're buying by the kilogram from refiners, not by the piece from dealers. This doesn't mean collectibles become worthless. It means their premium to spot compresses relative to historical norms. The metal content becomes increasingly dominant in determining value. The artistic or numismatic component becomes less relevant when the underlying commodity is in shortage. The psychology of this shift is important to understand. In normal markets, collectors pay premiums for rarity, beauty, historical significance. These factors command value independent of the metal content. But in shortage markets, industrial urgency overwhelms collector preference. The refiner who needs silver to fulfill a contract with Samsung doesn't care about mint marks or grade designations. They care about silver content and immediate availability. For those looking at mining exposure, the calculus shifts toward companies with specific characteristics. You want unhedged production, companies selling at spot prices rather than locked into forward contracts written when silver was cheaper. You want primary silver miners whose economics depend on silver prices rather than byproduct producers for whom it's secondary revenue. And increasingly, you want geographic diversification away from jurisdictions with political risk. The unhedged aspect deserves particular emphasis. Imagine two mining companies with identical operations. Company A hedged half their production by selling forward contracts at $35 per ounce when they were worried about price risk. Company B remained unhedged, accepting price risk in exchange for full exposure to spot prices. Today, with silver at $60, Company A still sells half their production at $35. The $35 gain from higher prices gets captured by whoever owns the other side of their hedge contract. Their profit improves marginally, but they miss most of the upside. Company B sells everything at $60. Their profit per ounce more than doubled. As silver continues higher, this gap widens. At $100 per ounce, Company A is still stuck selling at $35 for their hedged portion. Company B captures the full $100. The difference in profitability becomes enormous, and stock prices follow profitability. The geopolitical dimension deserves emphasis because it's likely to become more important as prices rise. We're already seeing this dynamic with battery materials broadly. The U.S. Inflation Reduction Act includes provisions requiring critical minerals to come from domestic or free trade partner sources for EVs to qualify for tax credits. Similar frameworks exist in Europe and Asia. These policies create a two-tier market where friendly silver commands a premium over unfriendly silver, despite being chemically identical. A silver mine in Nevada becomes more valuable to an American automaker than an equivalent mine in a country with uncertain political alignment because the Nevada supply qualifies for subsidies and doesn't carry supply chain risk. Timeline matters for positioning as well. This isn't a trade where you need to time the bottom perfectly. The structural forces are building regardless of short-term price action. What matters is having exposure before the market broadly recognizes what's happening. When Samsung begins commercial production of solid-state batteries and publishes the bill of materials showing significant silver content, awareness will increase dramatically. When the first major automaker announces a vehicle platform dependent on this technology, analysts will start updating their demand models. When supply constraints become visible through exchange inventories or delivery delays, prices will adjust rapidly. Each of these recognition points creates a step change in how the market values silver. The early positioning happens now, while the information is available but not yet consensus. The late positioning happens after these catalysts, at much higher prices with much more volatility. The psychological challenge will be managing the volatility that inevitably accompanies any commodity in transition from surplus to shortage. Prices won't move in a straight line. There will be corrections that feel devastating if you're watching daily. There will be rallies that feel euphoric, followed by sell-offs that feel like collapse. And on to that changes the underlying fundamentals. Samsung still needs silver for batteries, regardless of what the price did this week. Toyota still needs to meet electrification mandates, regardless of sentiment indicators. The supply still can't expand rapidly, regardless of what futures positioning looks like. Separating signal from noise becomes critical. The signal is the industrial offtake and the supply constraints. The noise is the daily price movement driven by positioning, sentiment, and technical factors. Participants focused on noise get shaken out during corrections. Participants focused on signal accumulate during weakness and hold through volatility. This is ultimately about understanding that we're watching a structural shift unfold in real time. Silver is transitioning from a precious metal with industrial applications to a strategic industrial material with precious metal characteristics. That transition takes time. It creates opportunities for those who understand it early, and it creates risk for those who miss it or misunderstand it. The Samsung solid-state battery represents the most significant demand catalyst silver has faced in modern history. It's not incremental, it's transformational, and it's happening now, not in some distant hypothetical future. The production lines are being built, the supply contracts are being negotiated, the technological decisions are already made. What hasn't happened yet is the market fully pricing in these realities. That gap between reality and price is where opportunity lives. But it won't live there forever. Information diffuses, markets adjust, recognition spreads. The industrial buyers who understand their requirements today will secure supply before the financial markets understand the implications. And by the time it's obvious to everyone, the positioning opportunity will have passed. This is why Friday's price movement, whatever direction it took, is largely irrelevant to the fundamental analysis. Short-term trading dynamics don't change the chemistry of solid-state batteries. Technical patterns don't alter the supply constraints of silver mining. Sentiment indicators don't modify Samsung's production timeline. What matters is understanding that we're at the beginning of a multi-year demand surge that supply cannot easily accommodate. What matters is recognizing that the market hasn't fully priced this shift yet. What matters is positioning accordingly before that recognition becomes consensus. Because when it becomes consensus, the opportunity transforms. Early positioning at reasonable prices becomes late positioning at elevated prices. Thoughtful accumulation becomes desperate chasing. Strategic patience becomes reactive scrambling. The silver bomb Samsung just triggered isn't a metaphor. It's a structural supply-demand imbalance being created by technological necessity meeting geological constraint. And it's unfolding right now, while most market participants are focused on everything except the periodic table. The Industrial Revolution didn't stop because markets thought metals were expensive. The electrification of transportation won't stop because silver supplies are tight. Technology dictates requirements. Markets adjust to meet those requirements, and prices move to wherever they need to move to clear supply and demand. We're watching that process begin. The question isn't whether it happens. The question is whether you position for it before it becomes obvious to everyone else. Because ultimately, markets reward foresight, not hindsight. They reward those who act on structural understanding rather than reactive sentiment. And they create wealth for participants who see industrial shifts before they become financial headlines.